Hello, everybody. Welcome to Friday. The S&P 500 was up almost a 0.5% today. We're not doing a show today. And matter of fact, next week I'll be on vacation, so I won't be doing any videos about the market next week, just so you know, as I mentioned yesterday. And today was just, a capstone to a really wild week. I mean, start off Monday, we're down 3%. Thursday, we're up 2.3%. Monday we're down because of the possible conflicts with Iran and Israel, combined with the, lower employment report that came out on Friday. This is a group that, including myself, that really wasn't, heavily involved in the investing world in the 70s and early 80s when we had our big inflationary spike the last time. So what we've been dealing with our whole investing careers is a recession. So the thought of recession definitely, is a trigger, definitely, and it's something we watch for and we talk about all the time. We look at it and all those type of things. And the Federal Reserve generally makes mistakes and kicks the country into recession. In this case, maybe for leaving it up for too long, and we'll see how this plays out. However, this was kind of an outsized move. It shouldn't have been this much of a drop and these type of things happening for the news that was happening. So what we're really seeing here is some structural issues within the markets where you've got big money players all on one side of a bet that starts to unwind a little bit because of some of this news, and then they're all unwinding it very quickly, and you end up with these bigger drops and this bigger volatility. It's just kind of the way things work as far as that goes. It's why the day trading and those type of things is so difficult to do, or picking tops, and you kind of want to hang in there. And so again, we are a primary direction up, a secondary direction is down. If you look at the hourly chart, we're actually back into a primary up direction, which I think is quite interesting. That's what happened back in May when we had our downturn in April, saw it on the hourly chart, and it just came right back and we set a new all-time high. I don't think that's going to happen here personally. Maybe it does. Again, I've been wrong more often on how strong the market has been, and which is kind of ironic because I really focus on the positive as far as that goes. But if you look at 2022, right, the low point was October 13th. If you look at 2023 last year, the low point was October 27th. Those fit really well within the narrative of having an election on November 5th. Because typically in my experience with these elections, September and October are kind of soft. They're soft normally anyway, but they're more so maybe in these presidential elections. And then November can actually, which is the best month of the year on average, can actually be even better than average as far as that goes. So that would be a likely scenario to play out. The Federal Reserve's meeting in September will have some impact on that one way or another, as to what they do. The expectation is for half a point rate cut. If they do 3/4, the market probably really likes that. If they do a quarter, the market probably doesn't like that. So these are things that are still to come that have some potential for catalyst. Of course, we got earnings reports still coming from companies like Nvidia, who have personally just driven the market straight up after some of their reports, which have been so great. But they've been doing it for over a year now, just really crushing their expectations, which continue to be raised and raised and raised. So it does seem likely at some point they will at least match them, if not meet them. So, we'll see what happens there too. But altogether, this is a normal part of the market. The market's up 15% in the first half of the year. You really don't want it to go straight up again to the next 15%. It sounds great, but if that causes a big crash and we end up with a 30% downturn or 40% downturn, because people start to kind of get on, the fear side, and things just take off. You really like these littler downturns, these 5, 10, 15% pieces kind of capture some attention for the people that are really interested in buying the dip, and boosh, the market kind of takes off. And you get all those short sellers who feel like the market's going to fall apart, who get hammered and they have to buy back. And, that's what's happened. That's what happened at the last two lows, the last 2 years. Those short sellers came in and really moved the market. And so you kind of need to stay in there. Um, if you look at last year, got panicked and moved out in October, man, you missed a 5% move in 1 week in November and an 8.9% for the month. So you kind of need to hang in there until that primary direction changes completely. Then you're now in a secondary situation where, the primary direction is down, and we're not there. That's not happening at this point in time. And we're not there as far as I'm concerned in terms of the economy. We just had a 2.8% GDP growth for last quarter. That's pretty good. That's pretty far from a recession. So again, there's some, overreaction to a recession, but I think most of that overreaction wasn't just sort of an emotional overreaction. I think it's people are piled up on the wrong side of trades. that have to unwind. These are big hedge funds and what have you that are out there, quant funds and what have you that, are having to unwind quickly. But the money came back pretty well this week. So we'll see if that continues to happen and see if it continues to roll. So anyway, that's what happened this week. Really, great week to kind of look at the market and try to understand how this works. I think it's a very educational week as far as that goes. So anyway, look forward to seeing you, I guess, in about 9 or 10 days when I do my next daily video. Thank you for watching and have a great weekend. Thank you.